Banking is the most profitable industry in the world. So why aren't you participating? See, banks are in the business of lending. They lend out money to make out more money. And you could do this inside of the infinite banking process. So let's break this down in this week's explainer video. To understand the banking industry, first you need to understand how the Federal Reserve works. Once you understand the Fed, you'll have a much better understanding of how banking actually operates. So as we talked about before, there's a revolving door that exists between the Fed, Department of Treasury, which is DC, and corporations, which are Wall Street. There's a revolving door of leverage that happens. So let's break this down and get a better look at how this works. So the Department of Treasury is going to issue out a bond order, and then a corporation is going to buy that debt from the Department of Treasury. The Fed is then going to buy that debt from the corporation in the secondary market. That money is then going to flow through the corporation and then end up in their bank account and then get lent out in a series of transactions. Let's take a closer look at what this lending out process looks like. So it's important to note here that prior to 2020, commercial banks were required to hold 10% of the holdings and they could lend out the rest of the money. But to the right of 2020, that rule no longer applies. So let's go through an example looking at JP Morgan with $1 million. So $1 million is going to come into our system, and this is going to be lent out through a series of transactions going through commercial banks. Let's look at our banks here. Let's call them A, B, C, all the way down to N. So we're going to break this down as it were for before 2020. So $1 million is coming in, 10% is being withheld, so 100K, and the rest, 900K, is being lent out. Pretty easy to follow, but this is where things get weird. So this 900K is going to go through a series of transactions, end up in commercial bank B, 10% is going to be held, and then 810K is going to be lent out. So what's this mean? As all these 10% holdings are added up, we're going to have 1 million, and then all of our lent out money is going to add up to 9 million. So there's a 1-to-9 ratio. That means the Fed is printing money as money is coming in. So what's the big takeaway here? So as more reserves enter the system, as the Federal Reserve is lending out more money, this is going to increase the amount of reserves in the system, which ultimately is going to increase the inflation in the system, which the consumer will pay for in the end. So what's the solution to this problem here? How are you supposed to dodge all the negative influences from the asset management industrial complex? So here's our shield wall here, and then here's our negative influences. We have inflation, tax, all of the negative impacts from the asset management industrial complex. So what do? Well, we can essentially create a shield wall from these different influences by creating our own bank. Let me break down how this works. So our investor here, let's call him Austin. He's going to have a whole life policy. He's going to contribute cash to this whole life policy, which is going to build up cash value. He could then leverage this cash value to buy a cash flowing asset, aka a piece of real estate. This piece of real estate is going to generate cash flow, which is then going to go back inside the whole life policy, and he could repeat this cycle continuously. And here's what's special. When you leverage the cash value inside of your whole life policy to buy that asset, your cash value remains intact because you're using the insurance company's money. So you're getting growth inside your policy as if you didn't take out any money while you get that cash flowing asset. So if you want to figure out more about this system and how you can incorporate whole life into your life, reach out to me at Generational Growth Co.